I will be discussing from now problems 12 and 13 and to whatever problems that I can discuss up to 11:30, and then after that I will just share screen the rest of the problems that we will not be able to discuss. And by the way, on Monday, my short quiz will be based on chapter 5. So just study chapter 5, and probably I will get the questions from the theory questions at the back of the chapter. So you try answering them so it will be better for you. Okay, number 12. Number 12 now. Uh, Use the following information for questions 12 and 13. The corporation acquired a 70% interest in WeSol Corporation on January 1, 2005 when WeSol's book values were equal to their fair values. So in other words, there are no over or under valuation. During 20X5, DAC sold merchandise that cost 75,000 to Weasel for 110,000. So that we have now 110,000, the transfer price, and the cost is 75,000. So in other words, there is an overvaluation of 35,000. And take note that DAC is the parent and Weasel is the subsidiary. So we now involve downstream sale. On December 31, 2005, three-fourths of the merchandise acquired from DAC remained in Weasel's inventory. Separate investment income not included of DAC and Weasel are as follows. So in other words, we are given the separate income items. However, investment income are not included. So we have now sales revenue, cost of goods sold, operating expenses, and now we have the separate incomes of the two companies, both Duck and Weasel. Now you will notice that separate incomes are computed based on the difference between sales revenue and cost of goods sold and operating expenses. The consolidated income statement for the corporation and subsidiary for the year ended December 31, 2005 will show consolidated cost of sales of. So in number 12, we have now the combined cost of sales. If we have now the amount of 160,000, that's the combined cost of sales. Then the intercompany sales revenue as at the transfer price of 110,000, and we add the unrealized profit taken out of inventory. So we have the unrealized profit equal to 75% of 35,000. Now that's the uh, sales rate. So if you have now 75 percent and we multiply it by 35,000. So we now have the amount of 76,250. That's the consolidated cost of sales. So take note that we are now deducting from the combined cost of sales we are deducting 110,000 and we are adding unrealized profit taken out of inventory. So we have now the amount of 76,000 for the consolidated cost of sales. Now, and number 13 requirement for number 13. Number 12 is boy. 13, DAX investment income for 20x5, assuming dividends paid by Weasel amounted to 40,000. So the investment income of DAX by using the cost method or the cost model. So we now have the answer to number 13. Under the cost method, it's 40,000 multiplied by 70%. And now if we use the equity method, it's given at 54,250. That's the equity in subsidiary income. Under the equity method, we have 115,000, 115 the separate income of Weasel 115,000 and then we multiply it by 70%. Now that's the amount of the share of DAC in the separate income of Weasel. And then we deduct 26,250 26,250 is the unrealized profit. So we have now the unrealized profit of 26,250. The equity in subsidiary income is equal to 54,250. So 4,250. As stated, why we have 75% because stated here that on December 31, 2005, three-fourths of the merchandise acquired from DAC remained in Weasel's inventory. So the three-fourths or 75%. So the unrealized profit taken out of inventory is based on the inventory. That's equal to three-fourths. Oh, so we now get three-fourths of 35,000. So the answer to number 13 is letter D under the cost model and under the equity method. Next problem that I gave, but anyway, I have given you. Next problem is 18 to 21, but I'm going to share screen the solutions to the other problems that I have not given. So we have now number 14, 15, 16, and 17 because I have given you number 18 only. Number 18 only. So we have now solution to number 13, 14, 15, 16, and 17. So we have now, okay, naka-share screen na kamuda. And we have now the next problem to discuss. I gave you numbers 18 to 21. So numbers 18 to 21. Okay? So let's take up the data. 18 to 21. Pilfer Company acquired 90% ownership of Scrooge Corporation in 20x3 of underlying book value. On that date, the fair value of non-controlling interest was equal to 10% of the book value of Scrooge Corporation. Pilfer purchased inventory from Scrooge for 90,000 on August 20, 2024, and they sold 70% of the inventory to unaffiliated companies. So meaning only 70% was sold. There's still a remaining 30%. On December 1, 2024, for 100,000. So meaning the cost is if we have 90,000, we multiply it by 70%, it's 63,000, and it was sold for 100,000. Scrooge produced inventory sold to Pilfer for 67,000. So if the companies had no other transactions during 20x4, what amount of sales will be reported in the 20x4 consolidated income statement? So we have now the answer to number 18. Sales to be reported in the consolidated income statement is 100,000 as given in our solution for the sales to uh, other companies. So, unaffiliated companies, sales of 100,000 sold actually by Pilfer. This time, we have an upstream sales because the seller of the merchandise is Scrooge selling to Pilfer. So we have now the sales to unrelated companies. That will be the only amount of sales that will be shown in the combined statements. Now, so number 18 is C. 19. What amount of cost of goods sold will be reported in the 20x4 consolidated income statement? So in 19, we have now a P company with the cost of sales equal to 67,000. Scrooge produced inventory sold to Pilfer for 67,000. So we have now the companies had no other transactions. So the amount of cost of goods sold that will be reported in the 20x4 consolidated statement is 67,000. So we have now S company for P company 67,000, and then for S company or Scrooge for 60 inventory of Scrooge. So the total is 130. Then we have the intercompany sales, the unrealized, the intercompany sales made during the period was 90,000. So 90,000, and we have now to add. And by the way, 19, we are computing for cost of goods sold. So we are now adding the intercompany sales here of 63,000. We are adding the initial amounts of cost of goods sold, and 130,000 we are deducting the intercompany sales from Scrooge to Pilfer, so 90,000. That leaves us 40,000, and we add the unrealized profit in the inventory of the parent. So we have the unrealized profit 90,000, and we multiply it by the gross profit rate. That's equal to 30, or we have the inventory rate. I'm sorry. The inventory is 30% because 70% of the inventory or of the merchandise was already sold. So we have 27,000, and we have now a 90 minus 67, and we divide it by 90. So if you have 90, that's sales price minus the cost of 67, and then we have the selling price of 90. So we have now the 27,000, and you multiply that by the ratio. So we now get the amount of 6,900. That's for the unrealized profit in the ending inventory of the parent, actually the parent. But the unrealized profit was unrealized by the subsidiary, being the seller. So 90,000 is the transfer price of the goods sold to the parent. So we get 27,000, and 27,000 the unrealized profit based on the markup rate. So 27,000 multiplied by 90, that's the sales price. Then we deduct 67 being the cost. So we now get 23 over 90. So we now get 25.555% multiplied by 27,000. We get a rounded off figure of 6,900. That's now your consolidated cost of sales. So the amount of the consolidated cost of sales in number 12, no? I mean in number 19, the amount of consolidated cost of goods sold is letter C. That's 46,900. So consolidated cost of sales. What amount of consolidated net income will be assigned to the controlling interest? Now, controlling interest is that of Pilfer. So we now get the amount of controlling interest. We begin with sales of the parent and the subsidiary. So we now get 90,000. That's the sales of the parent. And we deduct the cost of goods sold to the parent of 67,000. So we now get the difference of 23,000. In the books of the subsidiary, we have sales of 100,000 minus 63,000 being the cost. So we now get the gross profit of 37,000. Now the ending inventory is 27,000. Now the ending inventory is 90,000 multiplied by 30%. That's the inventory left at the end of the period. So that number 19, number 20, the answer is letter A for 51,490. Actually, in number 20, we are now asked to determine the amount of controlling interest in the consolidated net income. So we have now P company's net income from own or separate operations of 100,000 minus 90,000 times 70%. So we now get 37,000 as the difference between 100,000 and 63,000. Then we have the realized now since P is a buyer. The deferrals will not be recorded in its books. So we have now P companies realized net income from separate operations of the amount of okay, the amount of 37,000. Then we have S company's net income from own operations. We have now 90,000 minus 67,000 or 23,000. And we have the unrealized profit in the ending inventory of 6,900. Realized net income from separate operations of subsidiaries 16,100, that if we add to 37,000, that will give us 53,100, and we are going to deduct the non-controlling interest of 1,610, so the controlling interest of 51,490. Okay, now the amount of 1,610, that's computed as is company's net income of 23,000. Then we deduct the unrealized profit of 6,900. We have the difference of 16,100. So 16,100 multiplied by 10%. That gives us 1,610. That's now the non-controlling interest in the net income under the full goodwill approach. So in that case, the 1,610 as the non-controlling interest in net income for the period. So we are going to deduct 1,610. We are going to deduct from the consolidated net income, so that the balance is now the net income that will be the share of the controlling interest. So the consolidated net income for 53,100, 1,610 belongs to the non-controlling interest, and 51,490 belongs to the controlling interest. Okay, so we have now the questions to numbers 51,490. Okay, excuse me naman ang wifi ko. Okay, so that in number 21, what inventory balance will be reported by the consolidated entity? So the inventory balance now is 27,000, and we multiply by 67 over 90. So that gives us 20,100. The inventory balance that will be reported by the consolidated entity. Next, we have 22 to 24, 22 to 24. So we have now, I'll just share screen, 22 to 24. Okay. Then after that, we have 25 to 28. 25 to 28. Okay. Now we will take up 25 to 28. Okay. 25 to 28. Right? So in number 25, use the following information for questions 25 to 28. Patty Company holds 80% of the common stock of Shannon Incorporated. In the current year, Patty reports sales of 10 million and cost of goods sold of 7.5 million. For the same period, Shannon has sales of 200,000 and cost of goods sold of 160,000. During the year, Patty sold merchandise to Shannon for 60,000. So this time we have downstream sales at a price based on the normal markup. At the end of the year, Shannon still possesses 30% of this inventory. Number 25, compute consolidated sales. So we have now P Company sales of 10 million, and then S Company of 200,000 for the consolidated sales total of 10,200,000. And during the year, Patty sold merchandise to Shannon for 60,000 at a price based on the normal markup. So we are now deducting 60,000 for the intercompany sales. Now it's upstream because this time during the year, Patty sold to Shannon for 60,000 at a price based on the normal markup. At the end of the year, Shannon still possesses 30% of this inventory. So you will notice this time that Patty is the one selling merchandise to Shannon. So Patty is the parent. So it's more of a downstream sales. So we have now the unrealized profit in the ending inventory of Shannon. So we have 60,000 and we multiply it by 30%. As stated, at the end of the year, Shannon still possesses 30% of this inventory. So 30% or 18,000, and we multiply it by 10 minus 7.5 as in the books of Patty, sales of 10 million and cost of goods sold of 7.5 million. So we have now the gross profit rate of 2.5 divided by 10. So 2.5 divided by 10, and we multiply by 18,000. So we now get the total of the unrealized profit in the ending inventory of S Company in the amount of 4,500. And by the way, intercompany sales is downstream. The fact that the selling company is the parent and the buyer is subsidiary. So I hope you are making corrections. The consolidated sales in number 25 is letter C for 10,140. Then number 26, the consolidated cost of goods sold is computed at 7,604,500 in that's letter D. And in number 27, the consolidated gross profit is 2,535,000. So the consolidated gross profit in number 27, 10,140,000 minus the cost of goods sold consolidated. So number 27 is C. And number 28, assume the same information except Shannon sold inventory to Patty. Compute consolidated sales. So in this case, we have an upstream sales. The fact that Shannon is the one selling inventory. So we have now P Company 10 million, and then S company 200,000, and we have now the intercompany sales, and each Shannon is the subsidiary. So Shannon now is selling to Pati. It's an upstream sales in the amount of 60,000. So what we have now is Pati, instead of Pati selling the merchandise, it's Shannon. So 60,000, and we are now adding the unrealized profit in the ending inventory of P company, because the seller company now is Shannon and the buyer is Patty. So that in number 28, 60,000. The ending inventory is 30%. We have 18,000 times